We live in a surreal fixed income world. To help make sense of the current environment, we explore opportunities available to investors across global bonds, short duration, and European bonds. Negative real yields are plenty, interest rates remain near record lows, and opportunities have become harder and harder to find. And as the cost of capital plummets, investors need to be aware of new risks and rewards in a financial system undergoing unprecedented change. While equity valuations are sky high, yields on bonds are now at rock bottom. For the average investor who will hold a blend of the two, this is a surreal scenario. Investors must therefore redraw their boundaries, both in terms of geography and credit spectrum, and reassess how they perceive risk. Demand for global bonds continued to surge over the last year as investors continue to look for diverse and versatile sources of income. Given the headwinds facing fixed income markets, it is crucial to diversify your credit investments widely. We believe that choosing an active manager who has the flexibility to move in and out of geographies and sectors quickly, according to market conditions, is important. There are a number of different global investment-grade bond funds that cater for their risk appetite. Some funds concentrate on generating income, while others are more concerned about sheltering capital. In fixed income, a short-duration approach can lower the sensitivity to risking interest rates while maximizing risk-adjusted returns compared to medium and long-duration bonds. Short-duration bond funds need not to replace core or investment-grade fixed income funds, but it is important to have some protection from interest rates and inflation. It is also important to weigh up your goals when selecting a short-duration fund. If you dislike volatility, investment-grade short-term bonds offer high credit quality, low yield, and durations of less than a year. If you want to add a little more yield, you could consider a flexible, short-dated, high-quality Eurobond fund, many of which also add selective opportunities in longer-dated or slightly higher-yielding bonds. With less leverage and more favourable credit cycle, European bonds, and especially corporates, have a number of advantages. So where do the opportunities lie? For instance, at the beginning of August, there was strong demand when Germany sold 3.2 billion euros of two-year bonds with zero coupons. In fact, the demand was so strong that they could have been sold twice over. We believe that rather than chasing riskier bonds elsewhere, European fixed income investors should select a reputable active manager who can invest in both corporate and sovereign debt.